Portfolio Monitoring Credit Interview Preparation Guide. If you are preparing for credit portfolio monitoring or portfolio risk roles in banks or financial institutions, this video is built exactly for you. We have created very comprehensive interview preparation material, specially designed for credit portfolio and risk oversight teams. Not single-name credit analysis or basic ratio discussion. In this session, we go deep into how credit risk is monitored at the portfolio level, across sectors, geographies, ratings, correlations, concentrations, and economic cycles. You will learn how interviewers expect you to think beyond individual borrowers, and instead focus on patterns, trends, tail risk, stress scenarios, and early warning signals that protect the bank as a whole. Do watch this video till the end. This depth of preparation genuinely separates strong portfolio risk candidates from average ones. Explain the objective of credit portfolio monitoring and how it differs from single counterparty credit analysis. Single counterparty analysis focuses on one borrower at a time, its cash flow, leverage, business risk, and repayment capacity. Portfolio monitoring looks at the entire book, not just individual names. You want to see patterns, concentrations, correlations, and emerging risks that only appear when you zoom out. The objective is simple: protect the bank by spotting deterioration early, reducing concentrations, and ensuring risk is aligned with appetite. Walk me through the key metrics you would track for an ongoing credit portfolio review. You monitor leverage, coverage, liquidity, and profitability for each borrower. At the portfolio level, you also track exposure at default, internal ratings, rating migrations, sector exposure, counterparty limits, covenant headroom, and collateral values. Trends matter more than single data points. You're looking for shifts that signal rising or falling risk. Describe how you identify early warning signals, EWS, of credit deterioration. Early warning signals appear before defaults occur. You look for slowing revenue, falling margins, delayed financial statements, auditor concerns, covenant pressure, rising leverage, or management turnover. Market indicators also help: wider credit spreads, declining stock prices, or rating alerts. The goal is early intervention, not reacting after damage is done. A borrower's leverage ratio steadily increases. How do you assess the credit implications at the portfolio level? Rising leverage may be manageable for one borrower, but dangerous if multiple borrowers show the same trend. At portfolio level, you check: is this trend sector-wide? Is it tied to macro conditions? Does it increase tail risk for the whole book? You may escalate certain names to watchlists, reduce exposure limits, or require enhanced monitoring. Explain how portfolio concentration risk is measured and why it is important. Concentration risk measures how much exposure sits in one sector, region, borrower, or collateral type. You assess concentration through exposure shares, Herfindahl indexes, or simple percentage thresholds. If too much exposure clusters in the same area, a single shock can impair the entire portfolio. Diversification is the main defense. Concentration is the main weakness. Describe how you evaluate sectoral or geographic exposures within a credit portfolio. You group borrowers by sector or region, then analyze total exposure, rating distribution, and profitability. You overlay macro trends, for example, commodity cycles, real estate prices, or political risk. Weak sectors get enhanced monitoring, tighter limits, or stress tests. Geography matters because legal systems and economic stability differ widely. How do you use rating migrations to assess credit portfolio performance? Rating migrations track how many borrowers move up or down in internal or external ratings. Upgrades suggest strengthening credit quality. Downgrades suggest rising stress. A healthy portfolio shows stable or upward movement. A weak portfolio shows downgrades clustering around the same industries or time periods. Migrations help you evaluate whether risk appetite is being respected. Walk me through how you perform stress testing on a credit portfolio. Stress testing imagines severe but plausible scenarios. You start by shocking key drivers: revenue declines, margin compression, interest rate hikes, or commodity crashes. Then you re-rate borrowers, recalculate expected loss, and estimate which names move to watchlist territory. Finally, you aggregate impact to see capital needs, expected credit loss changes, and concentration hotspots. Stress tests reveal vulnerabilities that base case models hide. Explain the difference between expected loss (EL) and unexpected loss (UL) in portfolio monitoring. Expected loss represents average, predictable credit loss, calculated as PD times LGD times EAD. Unexpected loss represents volatility around that average, the worst case, unexpected tail outcomes. Expected loss affects provisions and earnings. Unexpected loss affects capital requirements. Together, they shape how resilient a portfolio is to shocks. A sector experiences sudden distress, e.g., energy, real estate. What steps do you take to reevaluate exposures? You start with a fast triage. Which borrowers are most exposed? Which have weak liquidity or high leverage? Then update PDs, covenant outlook, and stress scenarios. You may freeze new lending, increase collateral demands, or escalate high-risk names. Sector distress requires both immediate action and deeper structural review. Describe how correlation assumptions impact credit portfolio risk. Correlation measures how borrowers move together during stress. If correlations rise, for example during recessions, defaults cluster. How correlation amplifies losses and reduces diversification benefits. Portfolio models like credit metrics or economic capital frameworks rely heavily on these assumptions. Small changes can produce large swings in calculated risk. How do you monitor covenant headroom across multiple borrowers? You track each borrower's key covenant ratios and compare them with thresholds. You identify names with slim headroom and prioritize them for monitoring. At portfolio level, you assess whether too many names are close to breach, which signals rising systemic stress. This helps you intervene before loans turn non-performing. Explain the purpose of watchlists and how borrowers are added or removed. A watchlist captures borrowers showing early signs of weakness. You add a borrower when metrics deteriorate, leverage jumps, liquidity weakens, or industry stress rises. Removal occurs when fundamentals stabilize and risk returns to acceptable levels. Watchlists help risk teams focus attention where it matters most. A counterparty misses a covenant test. How do you escalate and manage this within portfolio oversight? First, verify the breach and quantify its severity. Next, notify credit officers and relationship managers. Decide whether to grant a waiver, renegotiate terms, or reduce exposure. At portfolio level, track how many names are breaching similar covenants. This informs macro or sectoral stress. Every breach must trigger structured escalation. Describe how loan performance metrics, NPLs, write-offs, recoveries, inform portfolio monitoring. Non-performing loans show active distress. Write-offs reveal losses already realized. Recovery rates show how much value is rescued after default. Trends in these metrics indicate whether risk appetite is being maintained. Rising NPLs or falling recoveries require immediate review of underwriting and monitoring practices. Explain how expected credit loss (ECL) provisioning works at the portfolio level under IFRS 9 or CECL. Under IFRS 9, loans move through 3 stages. Stage 1 uses 12-month ECL. Stage 2 uses lifetime ECL when credit risk increases significantly. Stage 3 applies for defaulted assets. CECL uses lifetime expected loss from day 1. At portfolio level, you aggregate ECL across borrowers, adjusting for macro forecasts and probability-weighted scenarios. Provisioning affects earnings, capital, and risk appetite. How do you incorporate macroeconomic forecasts into credit portfolio updates? You link forecast variables, GDP, unemployment, rates, inflation, to PD, LGD, and EAD. You run multiple scenarios with assigned probabilities and update expected losses accordingly. Macroeconomic overlays ensure models remain forward-looking instead of purely historical. Describe how to evaluate refinancing risk across multiple borrowers with clustered maturity profiles. You map all borrowers' maturities into a timeline. If many loans mature in the same period, refinancing risk spikes. You evaluate market conditions, borrower liquidity, and dependence on external funding. High clustering may push you to restructure terms, extend maturities, or reduce exposures early. How do you assess the credit risk of borrowers in cyclical versus defensive industries over time? Cyclical borrowers rise and fall with economic cycles: autos, construction, airlines. You stress test them aggressively and monitor industry KPIs. Defensive borrowers, utilities, healthcare, consumer staples, show more stable performance. You still monitor them, but the volatility is lower. Portfolio monitoring balances exposure between the two groups to avoid excessive cyclicality. End. A borrower's credit spreads widen sharply. How do you interpret and confirm whether it is systemic or idiosyncratic? If spreads widen across the sector, risk is systemic, driven by macro or industry events. If only one borrower widens, the issue may be idiosyncratic: weak earnings, liquidity stress, or governance issues. You confirm by checking peer spreads, rating actions, news releases, and internal watchlist indicators. Correct interpretation guides correct intervention. Explain how off-balance sheet exposures, guarantees, undrawn facilities contribute to portfolio risk. Off-balance sheet exposures behave like hidden commitments. They do not appear as funded loans today, but they can convert into real exposure under stress. Guarantees become payable if the borrower fails. Undrawn facilities may be drawn suddenly during downturns. So, you estimate their exposure at default, apply credit conversion factors, and monitor them alongside funded obligations. They matter because they increase true economic exposure during crises. Walk me through constructing a heat map for credit portfolio risk reporting. A heat map visually ranks risk across the portfolio. You choose key dimensions such as PD, LGD, leverage, covenant headroom, or sector stress. Each borrower or segment gets a color: green, amber, or red. Green means stable, amber means watch, red means heightened risk. Heat maps help senior managers see concentrated risk at a glance, without reading long reports. How do you monitor exposure at default (EAD) trends across a portfolio? You track funded balances, undrawn commitments, guarantees, and derivative exposures. You analyze growth rates. Which sectors or borrowers are expanding their usage? You review seasonal patterns and compare EAD shifts with credit quality trends. Rising EAD combined with deteriorating fundamentals is an early warning signal. Describe how risk-adjusted return metrics, RAROC, RoRWA, are used in portfolio decisions. RAROC, risk-adjusted return on capital, compares income to economic capital. RoRWA, return on risk-weighted assets, compares return to regulatory capital needs. These metrics help decide, should we increase exposure, reduce exposure, reprice risk, or exit certain relationships? They align credit decisions with capital efficiency and long-term profitability. A portfolio segment shows persistent underperformance. How do you diagnose drivers and recommend action? You break down performance into components: credit losses, downgrades, sector weakness, pricing issues, or structural problems. You analyze whether the issue is concentration-related, macro-driven, or underwriting-related. Then you recommend targeted actions: reducing exposure, raising pricing, tightening covenants, or reassessing borrower selection. Persistent underperformance demands structural solutions, not just tactical fixes. Explain how credit limit frameworks are applied and monitored across a portfolio. Credit limits cap exposure to sectors, borrowers, countries, and products. You track usage daily, compare it with approved limits, and investigate breaches. You also test whether limits still reflect current macro and risk conditions. If not, limits may need recalibration. The framework prevents excessive buildup of risk in any single area. How do you treat distressed borrowers during portfolio reviews? You classify them into remediation categories: watchlist, restructuring, or recovery. You reassess PD and LGD, evaluate collateral value, and examine refinancing prospects. You may prepare action plans, covenant renegotiation, exposure reduction, or workout strategies. At portfolio level, distressed borrowers signal whether systemic stress is growing. Describe the interaction between credit portfolio monitoring and capital planning, RWA impacts. Portfolio monitoring identifies PD, LGD, and EAD changes. These flow into RWA, risk-weighted assets, under Basel frameworks. If risk increases, capital needs rise. If risk improves, capital can be redeployed. Credit portfolio health directly influences whether the bank meets its capital buffers and strategic growth plans. How do you analyze and report concentrations in collateral types or loan structures? You classify exposures by collateral type: real estate, receivables, inventory, equipment, and by structure: secured, unsecured, revolving, term. You check how collateral values move with market cycles. You test whether LGDs increase under stress. You highlight clusters, for example, too much reliance on the same property market, because they amplify loss severity. Explain how PD and LGD models feed into portfolio-level monitoring and reporting. PD models capture likelihood of default. LGD models capture severity of loss if default occurs. At portfolio level, you aggregate PD, LGD, and EAD to calculate expected loss, provisions, and stress outcomes. If PDs rise across a sector, or LGDs rise due to falling collateral values, the portfolio's risk profile worsens immediately. These model outputs shape pricing, risk appetite, and capital allocation. A borrower with weak fundamentals continues to roll over facilities. How do you address evergreening risk? Evergreening happens when banks repeatedly extend credit to avoid recognizing deterioration. You challenge the rollover by reassessing fundamentals, reviewing repayment capacity, and testing whether PD should increase. You escalate the case to credit committees if justification is weak. You may reduce exposure or require collateral. Evergreening hides true portfolio risk and must be stopped early. Describe how you track industry KPIs to anticipate credit deterioration. Each industry has unique health indicators: ARPU for telecom, occupancy for real estate, load factors for airlines, rig counts for energy. You compare borrower performance against these KPIs. If industry KPIs fall, you anticipate portfolio stress before financial statements show it. KPIs act as real-time signals. How do you incorporate ESG risks into credit portfolio monitoring? You assess environmental risks, such as emissions, resource intensity, or regulatory exposure. You assess social risks, labor, safety, customer impact. You assess governance, transparency, board structure, accounting quality. You map ESG scores into PD adjustments or watchlist criteria. ESG issues often surface slowly, but create large, long-term credit problems. Explain how scenario analysis helps highlight vulnerabilities in the portfolio. Scenario analysis stresses macro and sector variables simultaneously. For example, higher interest rates, lower consumer demand, falling commodity prices, or currency depreciation. You observe which borrowers breach covenants, which sectors incur heavy losses, and how capital requirements shift. Scenarios show where the portfolio breaks and where it remains resilient. A macro shock, e.g. rate hikes, commodity crash, hits multiple borrowers. How do you assess second-order impacts? Second-order impacts occur after the initial shock. For example, rate hikes hurt real estate first, but later reduce consumer spending, which hurts retail borrowers. You map the chain reaction using sector linkages, supplier networks, and financing dependencies. This helps you move from reaction to anticipation. Describe how you prepare a quarterly credit portfolio review pack for senior management. You include exposure trends, rating migrations, NPLs, watchlist movements, sector highlights, stress test updates, concentration analyses, and outlook. You use heatmaps, charts, and concise commentary. The goal is to show senior leaders where risks are rising, where returns are strong, and where strategy must adjust. How do you reconcile differences between internal ratings and external rating agency movements? You compare internal PD logic with agency rationale. If agencies downgrade but your ratings do not, reassess your assumptions. If your ratings deteriorate earlier, investigate whether you captured risk faster. Reconciliation ensures both systems remain credible and aligned. Explain how portfolio diversification benefits are measured and monitored. You measure diversification through correlation matrices, concentration metrics, and economic capital models. Low correlations reduce unexpected loss. High correlations increase it. You monitor whether diversification is eroding. For example, if previously independent sectors start moving together. Diversification is the cheapest form of risk reduction. Provide an example, real or hypothetical, where you identified a portfolio-level issue early and helped mitigate it. Here is a simple hypothetical. You observe declining demand in the commercial real estate market. Occupancy rates fall, valuations soften, and several borrowers approach covenant limits. You escalate the issue early. The bank tightens lending standards, increases collateral requirements, and reduces exposure in vulnerable subsegments. When the downturn intensifies, losses are contained. Early detection protects capital. Describe how technology, analytics, and automation are transforming credit portfolio monitoring today. Modern systems use real-time data, machine learning models, and automated alerts. They pull financial statements, market spreads, news feeds, and operational KPIs automatically. They detect anomalies, forecast deterioration, and highlight watchlist candidates. Automation reduces manual work and increases consistency. Analytics improves prediction accuracy, allowing risk teams to act faster and smarter. Credit portfolio monitoring is not about reacting to defaults. It is about preventing them. This was a complete end-to-end interview preparation guide created specifically for credit portfolio monitoring and risk oversight roles. If you followed this entire session, you now understand how portfolio risk builds, how correlations and concentrations amplify losses, how stress testing reveals hidden vulnerabilities, and how early warning signals protect capital. Rewatch the sections on concentration risk, rating migrations, stress testing, ECL, and macro overlays. Practice explaining them clearly, because portfolio interviews test judgment, foresight, and control mindset, not just credit theory. For more deep, role-specific preparation across credit risk, portfolio monitoring, risk analytics, and banking careers, stay connected. And once again, do watch, revise, and master this material.